One of the most important roles in buying a home starts with the banking system. That's the operations and key players behind the lending process. And before you tune this out, because you've already been pre-approved, this part is especially for you. Because what I'm about to share might make you rethink your choice before it's too late. I've seen buyers feel completely confident in the lender they choose, only to get blindsided when things start to fall apart. Unexpected delays, last-minute denials, or even losing their dream home. So before you skip ahead, stick with me. I'm pulling back the curtain to show you how it actually works behind the scenes and the players involved. And trust me, it will blow your mind. So here's what I wish more people knew before they tried buying a home. A loan isn't just handled by one person. It goes through multiple hands before you get the money. The key players are the loan officer, the underwriter, the appraiser, junior and senior loan processors, the loan servicer, and something that's not a person but plays a huge role, the secondary market. But who is the most important? Well, it's the underwriter. They're the ones who actually decide whether or not you're getting the loan. Here's how it works. Your loan officer, along with the processors, gather and organizes your financials based on what the underwriter needs to feel confident approving your loan. But here's the mistake most buyers make. They assume a pre-qualification, pre-approval, and even a desktop underwriting means their loan is set. But the real underwriting process usually doesn't start until you're actually in escrow. A great loan officer doesn't just submit your financials, they package everything properly and present it in a way that makes it easier for the underwriter to say yes. But the underwriter isn't just about you, it also assesses the property itself. And this is the second most common reason why deals fall apart. The underwriter needs to confirm that the home is worth what you're paying for it. So they order an appraisal. And the appraiser does two things: determines what they believe the home is worth and checks for risk, things that could make the property a bad investment for the bank. But why does this matter? Because banks aren't just giving you money, they're lending it with the house as collateral. If you don't pay, they take the house back. But if the property has serious health or safety issues and someone gets hurt or sues, that house could become a legal liability. And if that happens, the bank could lose its collateral. That's why appraisers don't just look at the value, they also look for potential risk that could impact the loan. And before I continue, I know this is a lot of information. Instead of trying to write everything down, we conveniently created that custom Who's Who guide. You can download it anytime by clicking the button below or messaging us Who's Who. All right, let's keep rolling. Now let's talk about loan processors. Think of them as an assistant to the loan officer. Their job: collect paperwork, process documents, and make sure everything the underwriter needs is in place. And as a buyer, you'll likely be in contact with them a lot through escrow. Once your loan is approved and the deal closes, it gets handed off to the loan servicer. Just a quick reminder, a loan approval is not the same as a pre-approval. If you want to know more about this, check out our series, our No BS Guide to Buying a Home. Loan servicers manage your monthly payments, taxes, and your escrow account. But here's something buyers don't always expect. Your loan servicer can change over time. The company you send payments to might switch, even though your loan terms stay the same. But why does it change? The answer lies in a massive financial system that controls how mortgages work. It's called the secondary market. Even though it's not a person, it has a huge impact on lending. Banks follow strict guidelines, and many of those come from the secondary market. Here's why it matters. Once your loan closes, it's often sold to investors like Fannie Mae or Freddie Mac. But in order to sell that loan, banks have to make sure it meets strict requirements. Things like debt to income ratio. If your debts are too high compared to your income, they can't sell the loan. And if they can't sell a loan, they won't issue it in the first place. Selling loans frees up banks' money so they can lend to other buyers. And while banks are focused protecting their bottom line, who's making sure you don't get caught in the crossfire? Because at the center of all of this, the approvals, the appraisals, the underwriting decisions, they all come down to one key player who can either push your loan through or watch it all fall apart. And by the time you realize it, it's already too late. This person is so crucial to the process that they deserve their own designated video. Click on the next video to find out who they are, what they do, and why they matter more than most people think.